On behalf of the Bombay Chambers of Commerce and Industry, I, Utkarsh Joshi, would like to extend a warm welcome to all the distinguished guests and our participants present over here. The topic for today's conclave is role of credit in a $5 trillion economy. Credit is the cornerstone of the Indian banking system, playing a critical role in fostering economic growth, enabling financial inclusion, and supporting development across the sectors. By facilitating the transfer of funds from savers to borrowers, banks, financial institutions, and NBFCs act as a vital engines of the economy, ensuring the efficient allocation of resources. India aims to become the third largest economy by 2030, reaching the goal of $5 trillion by financial year 2026-27 and $7 trillion by 2030, driven by expanded credit availability in infrastructure and high growth sectors. Credit fuels growth, consumption, and entrepreneurship, but requires addressing credit accessibility, non-performing assets, digital lending infrastructure, and geopolitical balance sheet management, climate finance integration, and fostering a conducive regulatory environment which helps the innovative credit products. With this background, the Bombay Chamber of Commerce and Industry is hosting this conclave to delve into challenges and opportunities that India faces on its path for achieving the goal of a $5 trillion economy. I would like to welcome Ms. Pinky Mehta, President, Bombay Chamber, and CFO, Aditya Birla Capital Limited, to please deliver the welcome address for today's conclave.
Good morning, everyone. A warm welcome to the Banking Conclave theme, the role of the credit in $5 trillion economy. It is truly a pleasure to see you all distinguished gathering here today. I extend my heartfelt gratitude to our keynote speaker, Mr. N.S. Vishwanathan, former Deputy Governor of Reserve Bank of India and the Independent Director and Non-Executive Chairman of Axis Bank, as well as to all our esteemed panelists. With such an exceptional lineup, I am confident that today's discussions will be both insightful and inspiring. Throughout its rich history, the Chamber has been a driving force in Mumbai's development. Our commitment lies in fostering technology and innovation, serving as a bridge between the business community and the regulatory bodies to enhance the ease of doing business. We also prioritize building sound financial structures that provide sustainable, equitable, and inclusive growth. This year's mission statement, Collaborative Development Towards a Viksit Bharat, centers on 4 critical pillars: embracing digitalization, bringing ESG to the heart of business, enhancing ease of doing business, and fostering the culture of diversity, equity, and inclusion. Today's theme aligns perfectly with this mission. Credit is a lifeblood of any economy. It fuels growth, drives consumptions, and fosters entrepreneurships, and empowers businesses and individuals to invest in future. As India strives to become a third largest economy by 2030, with a projected GDP of $5 trillion by FY 26-27 and $7 trillion by FY 2030, the role of credit in driving these transformations cannot be overstated. Expanding credit in highly growth sectors like infrastructure, renewable energy, healthcare, and technology will be pivotal to achieving this ambitious goal. However, unlocking the full potentials of credit requires addressing the critical challenges, which includes improving accessibility for MSME and underserved communities, mitigating the risk of NPA through stronger credit assessment and monitoring mechanism, building a robust digital lending infrastructure to enhance efficiency, transparency, and security, integrating the climate finance into a credit ecosystem to support the sustainable development. Additionally, fostering financial literacy, creating innovative products like green bonds and social impact bonds, and maintaining a conducive regulatory environment will ensure that the credit plays a transformative role in shaping India's economic growth. By addressing these challenges, we can create more inclusive, resilient, and sustainable economy that meets $5 trillion milestones and beyond. Today, we have two highly engaging panel discussions lined up, managing balance sheet in a changing geopolitical environment and climate finance. Experts from the diverse sectors will share their insights and strategies during this panel, promising enriching discussions for all of us. Now, I know you are eager to hear from our expert speakers, so I will hand over the proceedings to our compare Utkarsha, who will guide us through the rest of the event. Thank you once again for being here and wish you all the fruitful and inspiring day ahead. Thank you.
Thank you so much, ma'am. I would like to welcome Mr. Rajiv Anand, Senior Vice President, Bombay Chamber and Deputy Managing Director, Axis Bank, and Co-Chair, BFSI Committee at Bombay Chamber, who will set the theme for today's conclave.
Good evening, ladies and gentlemen. Ms. Vishwanathan, thank you for being here. Joydeep, thank you for being here all the way from Singapore. India's GDP grew by 7% in 2023, 8.2% in 2024, making it the fastest growing major economy globally, bolstered by strong private sector investment and resilient financial system. Despite global challenges such as inflationary pressures and balance of payment issues affecting many countries, India has maintained its economic stability in this environment. However, achieving these high growth targets will require significant increase in credit availability, particularly in infrastructure and high growth sectors. The government and regulatory bodies must work together to create a conducive environment for credit growth and economic development. The role of credit in driving economic growth and development enables various sectors. Credit is a cornerstone of the Indian banking system, playing a critical role in fostering economic growth, enabling financial inclusion, and supporting development across sectors. The Indian banking system, including banks, financial institutions, NBFCs, mutual funds, insurance companies, broking houses, private equity and venture capital entities, act as a vital engine of growth for the economy, ensuring efficient allocation of resources. By facilitating the transfer of funds from savers to borrowers, the banking system enables the growth and development of these sectors. Credit fuels growth, consumption, entrepreneurship, and drives economic development and job creation. Expanding credit availability in infrastructure and high growth sectors is critical in achieving India's growth targets. Credit enables businesses to invest in new projects, enable their operations, and create new job opportunities. Credit is also a catalyst in terms of investment, consumption, and job creation. It also plays a critical role in financial inclusion and helps us reach the underserved populations and promotes economic activity. Credit accessibility remains a significant challenge, particularly among the MSMEs and low-income households. Non-performing assets, as Pinky mentioned, continues to be a somewhat challenge, requiring effective management and resolution strategies. Digital lending infrastructure must be developed to enhance credit accessibility, reduce costs, and improve efficiencies. Geopolitical balance sheet management is critical to mitigate the risks associated with global economic uncertainty. Climate finance integration is essential to promote sustainable development and reduce environmental impact. Therefore, transforming the credit ecosystem and promoting financial inclusion is a key mandate for all of us. Innovative credit products and services to meet the diverse needs of borrowers and promote financial inclusion is critical. Financial literacy and education are essential to enhance credit awareness and promote responsible borrowing practices. Innovative credit products and services must be developed to meet the diverse needs of borrowers and promote financial inclusion. Therefore, collaboration and partnership among stakeholders, including banks, financial institutions, NBFCs, and fintechs, is a necessary condition to be able to address these challenges as we go forward. Unlocking the power of credit to drive growth, consumption, and entrepreneurship in a $5 trillion economy is what we're going to talk about today. I really hope that you do enjoy the rest of the day. Thank you.
Thank you so much, sir. It is our privilege to have Mr. N.S. Vishwanathan, former Deputy Governor, Reserve Bank of India, and an independent director and non-executive part-time chairman, Axis Bank, with us today to deliver the keynote address. Mr. Nurani Subramanian Vishwanathan has been a career central banker. He joined the Reserve Bank of India in 1981 as a direct recruit officer and rose through the ranks and retired as Deputy Governor in March 2020. He has varied experience as a central banker, including handling administrative functions for RBI. As the Deputy Governor, he has handled the banking and non-banking financial structure, governance, internal control, risk management functions, and human resource management of RBI and enforcement. During his illustrious career, he handled the role of Director, Supervision Bank of Mauritius, that is Central Bank of Mauritius, and acted as the Chief Vigilance Officer and Head of Internal Audit, Industrial Financial Corporation of India. He was also a member of the Board of Securities and Exchange Board of India, SEBI, between July 2016 till March 2020. He has been invited to be a member of various international committees and organizations and has also been a part of various domestic bodies and committees. He is a director on the boards of Acquired Ratings and Research Limited and National E-Governance Services Limited. He holds a master's degree in economics and a bachelor's degree in arts from Bangalore University and has completed an advanced leadership program from Judge Business School, Cambridge University in UK. May I request our keynote speaker, Mr. Vishwanathan, to kindly deliver the address.
Ms. Pinky Mehta, Mr. Rajiv, illustrious members here. It's my proud privilege to be a keynote speaker on this discussion on role of credit in US dollar $5 trillion economy, which India wants to become. I was wondering how do I address this, but I thought I'll use a presentation. But I've not done any fundamental research, but I've used published data to make my presentation because it's just 25 minutes. So the context, I think all have been saying the same thing, but I still said it. India's GDP for 24-25 is estimated by about $4.27 trillion. There's a lot of talk on what's the target date for USD 5 trillion. There was a speech by the finance minister in January 24 where she said, we want to achieve $5 trillion in 27-28. So there's also the talk of it being 26-27, so I just use that. It's okay, sooner the better. The larger goal is to make India a developed economy by 2047, Viksit Bharat, as they call it. This is a kind of a short-term, very short-term target to get there. The medium target, of course, as you know, is to get to $7 trillion and then $30 trillion. It's very simple that to get to $5 trillion from where we are today or where we're likely to be end of this financial year, it's another $730 billion of GDP that we need to, additional GDP growth that we need to get there. As you know, there was a bit of blip in our growth in the last quarter. It was expected to be more than 6%. It turned out to be much lower. There are many factors that led to it. Fundamentally, there was, the growth in manufacturing, mining, all fundamental industrial activity was much lower than anticipated. But in growth, in any country, and in India in particular, it has to be credit-led growth because we do not have adequate, large number of promoters to bring money, so it has to be credit-led. And it's been so globally. And therefore, I thought the financial soundness of the credit delivery system has to be the most important element in this discussion, whether they are able to provide that kind of credit and do it in a robust manner. So I just picked up some interesting data from the latest financial stability report. it says that the credit outstanding as on September 24 was 167 trillion rupees. And of course, just to add as a point, this does not include credit delivered by the small finance banks. It's just the commercial, and private and public sector commercial banks. GNPA has been nicely coming down. Good news. 2.4 as of September 24. It's been continuously coming down. It's a good trend. There are a few concerns. I will come to it later. So let's talk of the good stories first. Net NPA is 0.6%. It's just about the same as March 24, coming down from 3.8. The return on assets have been going up, which again is a pointer to lower NPAs, right? Lower the NPAs, better the NIMs, the return on assets will keep going up. The CRAR for the bank system is 16.7%, marginally down by 0.1% from what it was March 24. Provision coverage ratio, which again says, for the NPAs, gross NPAs, how much is already provided for, it's about 77%, going up steadily after a small blip in March 24. There's a negative story there, which is that the cost of funds for banks is increasing. And this is led by increase in the proportion of term loans and decrease in CASA. And of course, increase in reliance on CDs, certificates of deposits, which are obviously costly. There's more detail on this as I'll come to later in the slides. We had a period of the growth of loans, growth of advances being much faster, and also therefore because of which banks relying on non-deposit source of funds. And recently the trend is that banks are slowly understanding that you cannot fund advances other than, it's too costly to fund advances through non-deposit sources beyond a point. And we see actually narrowing of this gap and the kind of, the rate of growth of deposit and rate of growth of advances kind of converging. The NBFC sector too has been very healthy. It has overall as a system, it has a CRR. Of course, RBI monitors the large NBFCs, not the smaller ones, and which is what actually matters. The large NBFCs have a CRR of 26% against a requirement of 15%, NIM of 5.1%, return on assets of 2.1%, and a gross NPA of 3.4%, which means is a fairly robust financial system when you look at the NBFCs as well. One of the things that we see, this is from the State of the Economy RBI Bulletin. If you see almost in the last quarter, almost all loan growths have been moderated across all segments as a system. Because as I said, it's partly driven by reduction in the growth of deposits, and the banks are trying to moderate it in line with what is their liability source which they have. And among these which you see here, even the color is difficult for you. Even on the personal segment, when I move, I think it's a problem. Even in the personal segment, it's been moderating. One of the areas of growth of advances was actually in the consumer loans, and even there we see a moderation taking place across the system. This is one interesting data which I sourced from the Financial Stability Report. It says that MSMEs, if you look at the incremental bank loans share, 19% to MSMEs, but non-MSME industry is 5%. It shows multiple things. One, there's possibly less capex happening in that segment, and post, the kind of experience in the 2008-14, a credit expansion period, maybe the banks are a little more cautious on lending to large projects. One, there are not too many good projects, possibly, and two, the banks are even more cautious, and that's being seen in the form of lower exposure incrementally to industry. While increasing the loans or increase the share of loans to MSMEs is good, it's not by itself, but I think if you want huge growth, I think it will be led by large industries. And one interesting story I just saw today in the newspapers today in Economic Times is that the growth of MV vehicles, commercial vehicles today has been a huge growth has been seen in the last quarter. So I think, maybe reversing some of the trends that we saw in the previous quarter, which led to reduction in the rate of growth. So this is what everybody has been talking. So I thought I will add my 2 cents to it. Obviously, there have been multiple studies about how much investment you need to achieve the growth required. And I think only a couple of days ago, the chairman of SBI, had indicated that one would need a total investment of about 1,000 lakh crores, to achieve the Viksit Bharat goal over up to 36. And he based on his assessment of a CD rate, a debt equity ratio, he said about 365 lakh crores will have to come from banking system, remaining from the capital market. There's a similar assessment that was made by Dr. Rangarajan as well in his speech on how do we reach Viksit Bharat goals. Interestingly, he too, of course, there are, the extent of investment required is a function of the incremental credit output ratio, which is the, fundamental principle of the Harriet Tubman growth development model. And his assessment is that if you look at incremental credit output ratio 5, then the requirement will be much higher. Currently, the ICOR is about 4.5. But there is scope for improving the ICOR because the lower the ICOR, the better efficiency the capital usage. And among the areas that one looks at is whether technology can reduce the incremental capital output ratio, whether AI can improve the incremental credit output ratio, and there are multiple thoughts about it. In fact, Dr. Rangarajan at least has been somewhat skeptical about what will be the impact of AI on the increment on the economy itself, because he believes there could be some displacement of jobs as well, and we need to find alternative ways to do that. Otherwise, we'll have a jobless growth, which is not good either. So, while NBFCs are playing an important role in credit, as is the capital market, they're all improving. The role of mutual funds, the role of capital market, the role of bonds, the role of stock market, NBFCs are all increasing. But still, if you look at the single largest source of credit, continues to be banking system. Okay? And therefore, a robust banking system is fundamental. And at least the Financial Stability Report points to that being the fact as of now. So credit market will continue to be bank-led. Among the things that I thought we must highlight is, the growth of Indian economy has also been driven by how agriculture has performed. Because see, the rural demand is fundamental to growth. And if agriculture does not grow well, it doesn't help the system at all. And we have 2 good news on the agriculture front. I think the kharif crop has been pretty good. The rabi sowing has been pretty good. And there is expectation that the agriculture sector will perform much better this time. And there is also some kind of indicators of demand, rural demand going up in some of the segments, like, commercial vehicles, tractors, etc. in the last few quarters. I believe there that somehow my sense is that the entire agriculture financing is largely led by meeting the PSL targets. I think we need to go a little beyond that. One looks at just the crop loans, increase in the crop loans as the way to look at how agriculture is being financed. I think we need to find more innovative ways of doing that, number one. And 2, I thought, even within the priority sector, beyond agriculture, there are some areas which RBI has recently included as part of the priority sector, which is, what you call up to 50 crores for startups. And I think we must look at startups that work towards improving agricultural productivity and find if we can finance them is one of the things I believe what banks should try to do now. Obviously, capex by large private sector players is important. Last year, the growth was largely led by government investment, and there's a limit to how much government can, invest in capex. And I think, therefore, there's a need. The benefit of government capex is that it can crowd in private investment. That's a possibility. But I think the larger investment has to come from the private sector, and there, the role of banks to support that at a reasonable debt equity ratio becomes very critical. So I believe that I gave the feedback information from the financial stability report, basically to say that the Indian finance system is pretty resilient, and if there's a time to support credit growth, the time is now, given the financial strength and the resilience of the system. But there are obviously headwinds. One, already we are talking of the Trump effect. One doesn't know, how the tariff system will work. There are a lot of worries about how the global trade will move going forward, and what it can do is, it could have impact on export-led growth. And why I'm flagging this is, again, Dr. Rangarajan in his address on the Viksit Bharat issue had said that some of the countries that grew fast later and are advanced economies like South Korea, Taiwan, they were all export-led. And in a world of the day-to-day, of the kind today, with possible tariffs and controls on exports, the area of ability of growing through exports has come down. So we have a large domestic market, all right, but I think we need also exports, and that could be one of the dampeners going forward. Obviously, geopolitical risks have only been going up. There's an assessment that it's gone up by 0.01% in the last quarter. Substantial withdrawals by FPIs. It has had two impacts. One, of course, it kind of does impact the rupee. It also impacts our reserves, right? It has that impact. That's something that, and obviously liquidity too. That's an important element that goes forward. Banks' reliance on high-cost funds is increasing. There's a slide next stage. I will show you how it is. While the overall NPA has been pretty good, one does see some incremental slippages in the personal segment, which has been one of the main drivers of growth in advances. And I think banks are already taking some action on that, and which is also seen in the form of lowering of the growth rate, moderation of the growth rate in all segments of loans, including the personal loans. Obviously, operational risk is on the rise due to cyber threat. And why I'm flagging all this is all these will one way or the other impinge on the ability of banks to lend, right? And while the going is good as of now, one needs to be wary and cautious of some of these developments, and take that into consideration while providing credit and expanding the credit balance sheet of banks. So I was talking about the increasing cost of funds. Look at how deposits have fared. Every quarter, the higher rate, interest rate bucket of the deposits is going up in percentage terms. Look at where the 7.5%, 7 to 8% bucket was just 2.8% in March 22, is today 62.9%. Even the 8% bucket has gone up from above 8% bucket has gone from 1.7 to 5.9%. And add to this the increasing reliance on CDs. Okay. One of the interesting things is that the interest rate of 7 to 8% is in the lower end. I mean, it's about 1 to 2 years bucket. Okay, because again, the people are not knowing how the interest rates will move. So it could be a double-edged weapon. One, you're trying to cover for possible future downward trend in the rate. But if there's no change, it also means that you have to refinance this at maybe at a higher rate later. So this is adding to kind of uncertainty, and this is actually adding to the cost. And why costs are important is that if you want to, fund capex, there's always this theory, right? You want to fund capex, you must provide it at a low interest rate. And if the cost of funds is going up, how do you fund at lower interest rate? Okay, and of course you also add, you might have questions on that. There is the bank's recent draft circular on, how do you provide for, project loans, That's also adding to the required cost of funds. But I have a different theory. I know it's possible or not. I believe that project costs, project loans which have construction risk, is not to be borne out of banks' money because they are public deposits. I think that should be funded by, that risk should be actually taken by the market, capital market, bond market. I mean, we don't have a developed bond market enough. But that's one of the things I believe. So it's a given actually that you have on the one hand a higher cost of funds. Number two, there's a regulatory requirement to make higher provision during construction period. Right or wrong, I'm not getting into it. But those are all going to be a challenge in how credit is going to be dispensed by the banking system or the regulatory segment for development or funding capex. So I would say banks need to support growth, but be mindful of asset quality. I did say that there is somewhat an increase in slippages in the personal loan segment. There hasn't been too much of large capital large project advances, so we don't know how that's going to pan out. But important, I think this was mentioned by Ms. Mehta also, I think Rajiv too, that choice of projects, proper assessment, and post-sanction supervision become very crucial. Otherwise, one can prove good money after bad, and that's very important. There's a lot of research which found that the global financial crisis was preceded by lowering of guard on credit sanction. There was a survey done by, a global survey was done, and across the board, all the banks' CEOs responded that they had lowered the credit sanctioning guardrails, and that was the result. So one must be very wary that ultimately the cost of repair is much higher. So I think that's something I want to I'm not saying that I'm not trying to throw sand on the wheel, so to say, but I think it's important to highlight this as we work towards supporting the plan to get to $5 trillion economy through credit. India has also had its own periods of high episodic growth in NPAs, and in fact, I had, in a speech I had made in 2016, I had highlighted how excessive growth, which was not linked to growth in GDP, was one of the reasons for high NPS at that time. And the extent of capital infusion that government had to do, and even private sector banks had to do to clean up their balance sheets was tremendous. So I think one cannot be oblivious to these elements. So, but I'm not saying don't take risks. Banks are in the business of intermediation. They are in the business of maturity transformation. And if you're saying that I'm going to be risk-free, then it is lazy banking. Then you put all your money in government securities. But I'm only saying that be cautious. It's not that we move towards a system where we just expand credit. Being mindful of the risk is something which one has to be cautious about. Similarly, but one positive thing is that we are not in the same world as we were in the 2011, 11, 12 period, because we didn't have adequate recovery mechanism. Today, one may have many views on IBC, but I must say that I have enough data, but this is not the place or time to do it. So I can say that the IBC has considerably improved credit culture in the system, and because of that, there's much better chances of recovery than we had before the IBC came into force. A lot of data on that. People start questioning about whether IBC is functioning or not. I just want to say one thing, is that you can make a sick person alive through resuscitation, but you can't take a dead person and ask for him to be brought back. Okay, so I think among the reasons for lower recovery that we see in the recent past is that I think banks are still, creditors are still, going too late to go through the IBC mechanism. I think doing it in the right time can still give one better chances. Uh, One talked of, inclusive growth. I think without financial inclusion, you cannot grow. We need a credit growth that is all-encompassing. We need to reach formal credit to all people as to the extent feasible. We have the digital stack, we have the Jan Dhan account, but I think the harnessing of that is still much less than is possible. So financial inclusion is, I think, very crucial for the kind of $5 trillion economy that we are talking of, and that has to be, credit dispensation has to happen across the board. It's not just the concentrated lending that we want. Two, it has two benefits. One, it enhances growth. Two, it reduces risk as well. So I think that's something we need to kind of work towards. And therefore, I just want to end this with what the governor wrote, the current governor wrote is the forward to the, at the end of his forward to the latest financial stability report. And he says that I think it kind of says what Reserve Bank wants to do. And I think that's a kind of message that all entities which are in the system to provide credit, I will have to take care of. And it says that, we want to continue to secure and anchor public trust and confidence to support India's aspirational goals. And that's, of course, the $5 trillion economy and whatever we call. But we remain committed to developing a modern finance system that is customer-centric, technologically leveraged, and financially inclusive. I think, so when we are looking at credit for, a $5 trillion economy and Viksit Bharat forward, and given that we have all the positive elements going for us, being mindful of the concerns that I mentioned and being conscious of this requirement is what I wanted to end. So I think if we do all that, I'm sure that we will reach the $5 trillion economy much faster than we had planned to achieve, and we'll be able to support the Viksit Bharat goals of India. Thank you very much.
Thank you, sir, for such an illuminating address. The floor is open for Q&A. Just a moment.
Thank you, sir. My name is Amit Vardhan. Thank you for your speech. A question regarding the inflation, which RBI closely monitors. What is your view on food inflation? Is it helping the rural India because most of them are farmers? And what would be the effect on the general classes and on the stress on the banking sector because of food inflation?
I think the food inflation, I don't want to talk in terms of a rural economy. I want to talk in terms of the strata of poverty. Okay? The fundamental principle I believe is that food inflation affects the people in the lower economic strata even more than anybody else. Okay? Because lower the economic strata, greater the contribution of food to their purchase basket, and higher the inflation there, greater the impact for them in terms of their ability to save. So if you ask me, higher food inflation reduces the ability of the people in the lower economic strata to save, because most of it goes towards consumption, number one. Number two, we can't wish away food inflation at all. It's something that we have to live with. But I think containing food inflation has to come from multiple sources. I think one, obviously improving the productivity in agriculture, improving storage, improving logistics. I think some of these are also very seasonal. You have factors like rains and unusual rains. You have factors like rains not coming in due time. All this impact the food inflation. But on a larger principle, I believe that managing inflation is very important. There's no point in looking at growth without containing inflation. So it's not that, can we do this without that? No. And I think what is sustainable is going to be a growth that is backed by low inflation. So I think that's the way I see it. So I would look at inflation not from an agriculture point of view. You might be looking in terms of whether there's an advantageous terms of trade between farmers and the non-farmers because of that. But we must look at, is that because of, are the farmers getting those prices? Or is it because of other seasonal factors? Is something we need to look at before we come to that conclusion in terms of terms of trade between agriculture and non-agricultural suppliers. So I would rather that taming food inflation is critical, and there are ways to do that. Some of them are logistics. So I think getting warehouses built, providing proper cold storage system, all those are important to get there. And of course, managing supply. I think the government has been doing that to an extent possible.
Sir, your chart was very alarming on the fact that industrial credit is growing only at 5%.
Yes.
And you said also that, and really the industrial credit now will be more in the form of newer capex,
Yes.
which you also mentioned the government is doing capex. Now capex requires construction loans, as you rightly said, either a factory or a road or whatever.
Yes.
Now that you are saying should be funded by the bond market. How will that play out?
No, the fundamental principle is that it's a fundamental principle that construction risk cannot be borne out of funds that are provided by public deposits. That's a fundamental principle. Okay, and so elsewhere it's bond market which funds that, number one, and two, once the construction risk is over, because bond market the price will be relatively higher. Okay, once the construction risk is over, they are taken over by the banks at a lower interest rate. They get financed. Once because the construction risk is over, the banks can lend at a lower rate. No, I am saying that the fundamental principle I am saying is that I don't have a problem with post-construction risk, the loans being taken over by banks. Or because they do not run the risk, because the highest risk in the project is the construction risk. Once it starts earning cash flows, anybody can finance it. And banks have the ability to finance them at a lower cost because traditionally the cost of funds is lower. But in our country, given that the bond market is what it is, it's still the banks which do, and therefore they have to provide for the capital.
Sir, you put up that slide on how cost of funds is going up. Is it a monetary phenomenon? Is it because of the fact that customer behavior is changing? And the most important question, is it cyclical or structural?
Yeah, three questions in one. I think it's like this. There is potential for advances growth. Okay, banks are seeing that. And the liquidity support for that is not coming in the form of deposits because there are other avenues for, people say that ultimately everything will come to the banking system. But even if it comes, the color of that money changes. I think it's very important because people say, how does it matter? See, today, interestingly, if you look at, we are talking of liquidity shortage at some time, okay, but the variable reverse repo auctions are going at good prices. The banks are willing. That's because the liquidity is not durable. They're short-term liquidity. You cannot lend them out of that, okay? So the point is that what we require is durable liquidity, and maybe some of these funds do not provide them if it comes through other channels, number one. So that's one element. Two is that it's cyclical, structural. My view was that if there are no people who understand that there are other sources of parking savings than just banks. Okay, so that part will continue. To that extent, there's a structural change in the saving behavior of people in India. To that extent, it's structural. Okay, it's cyclical to the extent that it could be. It's also a function of how the liquidity in the system is functioning. So, if you look at the state of the economy report in the bulletin from which I have drawn this, the argument is that the liquidity is not, because I think after the CRR cut, it's not so low. There's also some money which gets withdrawn because of the exchange operations of the RBI. So one has to see, ultimately this problem will come down if some of those larger liquidity issues are contained. But I believe that banks will also have to kind of, you can't cut your legs to the shoe size, but somewhere, I think the banks are learning it, that there's no point in this mad race to raise deposits at any cost and fund advances. So I think, and it's also partly happening because there's a kind of what you call moderation in the return on assets in the consumer segment as well, because of higher credit costs.
Good morning, sir. I have a small question.
Sir, just a moment. We'll take one last question.
I'm Pramod Shah. I'm president of Bombay Management Association and former chairman of the Institute of Complete Settlements of India.
Yeah.
So I would like to have your views on the Indian banking scenario globally in 2047. And number one. And number two, sir, do you think that the RBI has played this role in monitoring the banking sector very well? So you are an ex-banker, so that's why. Thank you, sir.
What bank 2047? One, I think it will be an entirely different banking system. Let's be very clear across the globe. I mean, there are interesting books, where which talk of banks segment 4, bank 5, where it will all be, the physical branches will completely vanish. There will be different ways in which banks will organize themselves. But I think, let's be very clear that as the economy moves towards being a large economy, third largest, and getting to the $30 trillion economy, the banking size will become big. Banking system will become big, and Reserve Bank realizes that. And while there has been no new bank licenses, the fact that the Reserve Bank has put the new banking license on, online, you can ask for it any time. That's something which RBI has done, but maybe there isn't any promoter yet who has been found to be fit and proper, or maybe the application that is lying up there. So there will be more competition. Banks will definitely become much larger than they are today, and which will also mean that you will have, if you are becoming third largest economy, and which will mean supported by the banking system among other providers of credit, you will have much larger banks in the global table than we have today from India. Okay, that's one scenario.
Morning, sir. Utkarsh, just one question.
Okay, yeah.
I want to answer whether RBI has done its right job. I think yes, not because I'm on the both sides. I was in the RBI earlier. I'm now in a bank, chairing a bank board. I would say largely yes. Wherever banks have failed, let's be very clear. The problem that India had post-2015 in the form of huge NPAs in the banking system, the cost of getting to where we are today has been tremendous. I mean, there's been infusion of capital by the government. There's been infusion of capital even by the private capital in private sector banks. I mentioned about that. So the cost of repair is much higher than avoiding a repair. Okay, I think what Reserve Bank is trying to do is something of that kind. Okay, it may not look, some may not like it, but I think one must look at a more futuristic angle, and I think one will realize that we are avoiding a problem than creating a problem than trying to solve it.
Good morning, sir. So just one small question I had.
That's a sincere request. We could have the discussion outside the venue as well.
Just one question, sir,
Okay.
very related to what we're discussing, and I'm really glad you shared your insights with us. The question is about the write-off of corporate debt, versus the small retail borrowers. So if it's a systemic issue, and if it is a systemic issue, what is being done about it? Because there have been instances, and as a lawyer I'm privy to certain such instances where after the write-off, when the bank is following up with the defaulters, the kind of actions that most banks take, is merely kind of ticking off the boxes rather than going behind the defaulters to get them to pay, because ultimately that's also public money. So the corporate debt write-off is a problem. I wanted your thoughts on this, sir.
So I think,
Thank you.
You made a point on post write-off what happens, but I think we must make a very clear and distinction between a settlement and a write-off. Okay? And write-off is a technical write-off where, it's a tax management issue fundamentally. If you don't make, if you make provisions are not getting tax deduction. Okay, number one. So the principle is that you are managing your tax, number one, and whatever the obligation of the borrower to repay is not in any manner coming down. Okay. But if you are saying that in cases of borrowers where the banks have written off, their recovery process are lackadaisical, that's a different issue, and that could be, that may be so even after they have not written off. I don't think it's making any difference because written off and not written off. And for me, the write-off is essentially management of the balance sheet and tax outcomes rather than anything else. That's my view. You have individual cases that could be, but I think the banks are the borrowers are not aware that that particular account has been written off.
Thank you, sir, for such an illuminating address. Just a minute. I now request Mr. Rajiv Anand, Senior Vice President, Bombay Chamber and Deputy Managing Director, Axis Bank, to please present a memento to our keynote speaker as a token of appreciation.